Welcome back to EconSphere, where we cut through the noise and explain what's really happening with your money. And today, we're uncovering the truth about inflation in America. Because while official reports may show inflation rates slowing, the reality for millions of families is that prices remain painfully high. So join me as I take you on a journey beyond the headlines and reveal the deeper forces at play in our economic landscape. Let's start with a simple question. Are prices actually falling? It's a question that hits home for all of us because we're experiencing it every day in the rising cost of living. But here's the catch. Yes, inflation is cooling as the rate of price increases is slowing. That's exactly what the headline CPI numbers suggest. But here's the missing piece. When the rate goes down, it doesn't mean prices are actually falling. They're only rising more slowly. Let me illustrate the difference because it's crucial. Imagine you're at a store where you used to buy a TV for $1,000. But due to inflation, the price went up to $100. Now let's say inflation cools and the price stops rising for a few months. Does that mean the TV is now cheaper? Not really. It's still priced at $100. The only change is that its price is no longer growing at the same pace as the overall inflation rate. In this case, you might think, well, at least I'm not losing another $100 to inflation this year. But in essence, you're still paying more than before. And that's the key point. Even when inflation cools, many items remain expensive and their prices continue to rise, just not as quickly as before. And here's why this matters. You and I both know that prices haven't magically fallen back to 2019 levels. Groceries, rents, gas, and even haircuts are still costing us more. So even though the official numbers may suggest a slowdown in inflation, it doesn't necessarily translate to relief at the cash register or the pump. Now, let's talk about the disconnect between government statistics and our lived reality. How does it affect us? Well, for starters, the Consumer Price Index, or CPI, which is what we often refer to as inflation, is a measurement of the average change over time in the prices paid by urban consumers for a basket of consumer goods and services. It's essentially a snapshot of how much things cost. But here's the problem. Averages can be deceiving because they mask the reality that some prices are skyrocketing while others are falling. Take food, for example. We all know that our grocery bills are higher than ever. But the CPI might suggest that overall food prices rose by only 3% last month. How can there be such a gap between the official numbers and what we experience every day? Well, the answer lies in the composition of the CPI basket. The government assigns different weights to various items based on their importance in our budgets. For instance, the weight given to food might be 14%, reflecting its significance in an average consumer's budget. However, for lower-income households, food could account for a much larger share, say 30 or more. This means that if food prices rise by 5%, as they have in reality for many staples, it will have a bigger impact on their budgets than the CPI suggests. It's a similar story with housing, which accounts for around 32% of the overall index. If the average rent nationwide only increased by 2%, that would contribute 64 hundredths of a percentage point to the overall inflation rate. But we know that rents in desirable areas have surged by double digits, far outpacing the national average. The disconnect arises because the CPI measures a hypothetical average rent based on data from landlords and rental websites rather than actual transactions. This mismatch between official inflation and the reality on the ground leaves many feeling frustrated and left behind, especially those on fixed incomes or struggling to make ends meet. You might be wondering, does this disconnect between official inflation numbers and our lived reality have anything to do with the recent banking turmoil? Well, here's where things get really interesting. When the government tightens monetary policy to tackle inflation, as we've seen recently with several interest rate hikes, it creates a ripple effect across the economy. One of the consequences is that borrowing becomes more expensive. Mortgage rates, car loans, and credit card interest all start to climb. And when these costs increase, It directly affects people's disposable income. In fact, just consider this. According to Black Knight Research, mortgage payments have already surpassed rent payments for 4 million homeowners. Imagine you're someone who bought a home in the past year with a fixed-rate mortgage at an interest rate of 7%. Your monthly mortgage payment is likely around 20% higher than if you had bought the same house in early 2020 when interest rates were around 3%. This means a significant portion of your paycheck is now going towards housing, leaving less money for other essential expenses like groceries, utilities, and transportation. So yes, the recent banking turmoil adds another layer to this complex picture. As people lose faith in the banking system and the safety of their deposits, they might start to panic. Withdrawals, which can exacerbate the very inflation that the government is trying to contain. It's a delicate balancing act that policymakers must navigate carefully. So, what's the truth about inflation? Well, it's not just a number. It's a reflection of the changing value of your money, the products you buy, and the services you depend on. While official inflation rates might give us a broad perspective, they don't always capture the full story. Understanding the nuances, the gaps, and the challenges faced by different segments of our society is crucial. Only then can we work towards creating a more resilient and equitable economy for everyone. Here's the deeper truth about inflation that most people don't understand. Think back to 2020 when the economy shut down due to the health crisis. To keep businesses afloat and workers employed, the government unleashed a wave of stimulus measures. People received direct payments, extended unemployment benefits, and forgivable loans. At the same time, the Federal Reserve dropped interest rates close to zero to encourage borrowing and spending. But here's where things took an unexpected turn. These measures, intended to help the economy weather the storm, injected trillions of dollars into the financial system. And when there's more money chasing the same amount of goods and services, prices tend to rise. Suddenly, we found ourselves in a world with more dollars and the same stores, restaurants, and houses. It's basic economics. For example, imagine a small town with one coffee shop where a cup of coffee cost 5 yuars. If everyone in town suddenly had $100 more to spend, they might go out and buy 2 coffees instead of 1. The coffee shop owner, noticing this increase in demand, might raise the price to $6, knowing that people have more money to spend. And before long, the price of that coffee could rise to $7. This phenomenon is what economists call demand pull inflation, and it was only the beginning. Supply chain disruptions caused by the health crisis led to shortages of goods and services. Factories shut down, transportation networks were strained, and stores couldn't keep their shelves stocked. All of this contributed to a surge in inflation that we've been experiencing. The problem is that once inflation starts to bite, it can be hard to stop. Here's why. Let's say you're an employee earning $50,000 a year. If inflation averages 3% annually, your purchasing power erodes. In 5 years, that $50,000 won't be able to buy as much as it could when you first started your job. To maintain your standard of living, you'll need a raise. And here's where things get tricky. If you ask for a raise of, say, 8%, your employer might agree. But that doesn't just benefit you. It also contributes to inflation. Now you have more money to spend, which could drive up prices even further. So the next time you ask for a raise, it might be 10%, and then 12%, and then 15%. It becomes a vicious cycle. Now enter the Federal Reserve, the central bank of the United States, responsible for keeping inflation under control. When inflation rises, the Fed typically raises interest rates to try and cool the economy and bring prices down. But that, too, has consequences. Higher interest rates make it more expensive for businesses to borrow money, potentially leading to layoffs. It also makes it harder for people to buy homes or cars, which can slow down economic growth. The truth is, the U.S. economy has become addicted to cheap money. When interest rates were near zero and free money was flowing, people and businesses borrowed heavily and spent like there was no tomorrow. But now that the music has stopped and the party is over, we're facing the consequences. We're seeing companies with unsustainable debt loads, shaky banks, and people who can no longer afford the lifestyle they've become accustomed to. So, what can we do about it? Well, the lesson is clear. Don't wait for Washington to fix it. Take control of your own financial future. Diversify your investments. Cut high-interest debt and build a financial cushion to protect yourself against future shocks. Educate yourself about personal finance. Learn to invest and consider alternative career paths. The bottom line is this: the system is designed in a way where the dollar steadily loses value over time, making knowledge and preparation your best defense. The path to financial freedom begins with understanding how the system works and taking proactive steps to secure your own future. Remember, while the headlines may paint a rosy picture of an economy rebound, your financial well-being is in your hands. Stay informed, stay resilient, and keep moving forward. And remember, if you felt this disconnect between official inflation numbers and your lived reality, share your story in the comments. Hit the like button so more Americans can hear the truth, and subscribe to EconSphere for more daily insights into money, markets, and the economy. Because understanding inflation isn't just about numbers. It's about how it shapes your everyday life, your future, and your financial freedom. Thanks for joining me on this episode of EconSphere. Stay curious and keep learning, because your financial education is your most valuable asset. See you in the next video.